Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Lead Partner. Welcome to our second January 2016 webcast. The title of today's webcast is The ISB has completed its deliberations on IFRS 4 Phase 2. Last set of decisions on unit of account and indirect par. As always, our agenda is structured on three items. The first one, the highlights of the ISB meeting, which was held last week on the 19th and 20th of January. Then we'll spend most of today's webcast to discuss the ISB staff analysis of the various issues tabled, the ISB discussion, and the tentative decisions that followed. I will then spend a few minutes at the end to present our view as to the next steps to completion of the project. There are four highlights from today. The first is that this meeting has now been declared to be the last substantive discussion meeting on the project for the new IFRS on insurance contracts. So we really seems to be in sight of the finish line for this multi-year project. As anticipated in our previous webcasts, the decisions on unit of account and on indirect participation contracts were debated and voted. The first key decision on the unit of account is that the portfolios of contracts that we have seen defined in the exposure draft of the new IFRS for the last few years will now have to be subdivided in separate groups. That's the new term that has been decided upon. Each group will be combining a number of contracts that present similar levels of expected profitability at inception, and that they respond in similar way to the risks surrounding the amount and timing of cash flows. So if they are not the same, the portfolio will have to be subdivided into separate groups. And that group is the unit of account for testing the group against the onerous contract status. Even when such diversity on profitability is caused by regulation, you need to take that into account and separate the portfolio accordingly. The second key decision is that insurers can use these units of account to release the CSM to profit or loss, but need to respect the principle that derecognition of contracts releases any residual CSM to profit or loss. And we'll see later on in more detail how this could be done in practice. Finally, the solution to the indirect participating contracts is not to include them in the scope of the variable fee approach, as some of you may have hoped. Instead, we will stay in the general measurement model, but the CSM will be unlocked when the insurer changes the expected level of policyholder bonuses established at inception. This is the new decision that the ISB has reached on the accounting for discretion outside the VFA. Other changes from market variables will go through P&L or the OCI, depending on the presentation of discount rates. These are the highlights, quite a number of important decisions, as you can see. Let's now start with the level of aggregation to understand in more detail how the ISB has reached these key decisions. And I would like to start by running through the overview of the issues discussed in paper 2A and in the addendum to that paper that was tabled last week. The level of aggregation, as we all know, needs to be considered because in some circumstances gains are treated differently to losses in the Phase 2 accounting standard, and therefore an accounting mismatch may be created in the financial statements of an insurance company if a contract-by-contract accounting is required. So an entity needs to recognize a positive CSM and release that CSM over the coverage period, but we'll have to recognize a negative CSM immediately in profit and loss. Those are the differences in the accounting treatment that need to be considered. There may also be other differences in the treatment of gains and losses in allocating the CSM. So all these reasons, given the nature of the business of insurance, would suggest that a contract-by-contract accounting is not the most faithful representation of the underlying economics. However, from an onerous contract perspective, the issue about recognizing that status is important, and although it is equally important to avoid recognizing losses that arise on individual contracts because of events that may be pertinent to that individual contract, there is a level of aggregation that must be specified to identify when onerous contracts exist in the financial statements of an insurance company. And the paper explains how to get there. Similarly, for the allocation of the CSM, there is a principle that is being designed and developed in a way that it relates to individual contracts, whereby once the CSM is identified, it should be released to P&L over the coverage period. And when the contract is de-recognized from the balance sheet of the insurer, any residual CSM is taken to profit or loss at the point of de-recognition. That marks the end of the earning period for that particular contract. Alternatively, the earning will continue up until the end of the coverage period. If you are accepting that a group of contracts should be used as the basis for the allocation of the CSM, the issue around reflecting faithfully the de-recognition of the contracts becomes an important issue, and the paper addresses it. Because the issue here is that a group of contracts being accounted for may not necessarily produce the results of recognizing faithfully the de-recognition of contracts. The paper also highlights the fact that there are situations in the markets of insurance contracts where the level of aggregation may be required for contracts that have been impacted by pricing regulations. These regulations will effectively impose on the insurer certain requirements that will prevent the insurer to having the practical ability or even the legal right to fully reflect the risks of the policyholders that are purchasing the insurance contract. The question then is, should the presence of regulation and the possibility for different groups of policyholders to be generating an expected profitability at different levels be reflected in separate groups within the portfolio or not? And the staff in the paper did not recommend that there should be any exception due to the restrictions that regulations may impose on insurance contracts pricing, because a difference in profitability is a real economic difference, whether it is arising from the way the prices are established in a free market or whether they are affected by regulatory requirements. It becomes less relevant if the importance of communicating the profitability of the group is the objective that the new IFRS should achieve. So with all these considerations, let's look at how the staff has put forward their recommendation. The first one is on onerous contract, and the staff recommendation here was that a loss for onerous contracts should be required to be recognized only when the CSM is negative for a group of contracts, and that the group should comprise contracts that at inception A have cash flows that the entity expects will respond in a similar way to key drivers of risk in terms of amount and timing, and B had similar expected profitability. So two conditions, both of which must be true at inception of the contract. Let's see how the ISB members responded to this recommendation. The discussion was actually quite lively, and you can replay it if you have some time in your hands. It's quite long, but it's worth listening to it if you are interested in a greater level of detail than what I can offer you in this short webcast. The discussion, as I said, raised a number of comments, and I've summarized here and in the next slide the most important ones in my opinion. First one is that there were a number of board members that noted that this recommendation was drafted in a way that appeared to be rather prescriptive and rules-based, and they would have preferred instead some narrative a little bit more inspired by a principle-based approach. Another comment we heard during the debate is that there was a level of satisfaction by a number of board members because they felt that this recommendation was moving IFRS 4 Phase 2 to be consistent with the IFRS 15 principles in terms of recognition of revenue. Another positive comment was that they felt that the recommendation appeared to capture well and faithfully the business model of insurers. That's is the opinion of a few ISB members, of course. And another interesting comment that at this stage does not appear to have been reflected in full in the decision, so we'll have to hold our breath on that. But some board members question whether there should be a reassessment of the unit of account. The published tentative decision doesn't refer to any reassessment whatsoever, so we should assume that there isn't one. But some of board members actually suggest that if inside a group of contracts there is a subgroup that deteriorates or, for all that matters, improves significantly the expectation of cash flows compared to the other part of the group, then the group should be split in two components, and the contracts that respond now to different ways to the risks affecting amount and timing of cash flows should no longer be part of the same group, but they should be instead be part of two separate groups. As I said, there is no indication that the board is actually expecting to impose a reassessment, but comments were made in that regard, and so we'll see whether this somehow re-emerges in one of the future meetings of the board. The discussion then continued around the word of similar expected profitability, and in particular the word similar was pointed by a number of board members as an area of the text that could raise different interpretations in practice, and the possibility that marginally loss-making contracts would be grouped separately from profitable contracts, even if other features were the same, was also debated as a result of the requirement, and whether it would be an appropriate representation to do so. The staff responded to these various different observations on the similar profitability, noting that for sure they anticipated that this would be an area of interpretation that would require judgment, and although they are going to write some application guidance, the fact that judgment will be required remains a fact of life. The final text of the new IFRS should include some examples to illustrate what is meant by similar expected profitability, so there will be hopefully a complete set of application guidance paragraphs to tell us a bit more about that. Having discussed all these aspects, when the board then came to a vote, based on the recommendation which effectively has been carried forward into the tentative decisions record, the unanimous vote was recorded on this particular point. The staff recommendation then moved on the second major topic on the unit of account, the level of aggregation, and that is the allocation. And here the recommendation was quite elaborate. And what you see here is the text that was tabled in the addendum to paper 2A, which was presented on Wednesday, the 20th of January, so the following day of the originally scheduled insurance contracts discussion. Divided in three parts. The first part, part A, is the objective of the allocation. And the objective is to recognize the CSM for an individual contract, and note the emphasis which I added, in profit or loss over the coverage period of the contract in a way that best reflects the service to be provided by the contract. Hence, if there is no more service to be provided by a contractor after the end of the reporting period, the CSM for that contract should have been fully recognized in profit or loss. So you can see here there is no reference to any level of aggregation, so bear that in your mind. Part B says an entity can group contracts for allocating the CSM provided that the allocation of the CSM for the group meets the objective in A. And so although the objective is effective on a contract-by-contract basis, you can aggregate contracts and do it all together with one single algorithm applied to the cumulated CSM balance of that group of contracts, as long as you respect the principle of full release of the CSM for derecognized contracts, which is clearly the point. The other one is the release of the CSM over the coverage period that we know from previous discussion in our webcast is based on the passage of time for non-participating contracts. And then we move to part C, which is how do you meet objective in A if you are using a group-based accounting? And that is done by effectively following two conditions. Condition C, Roman 1, is that you are grouping the contracts in the same way as you would group them for onerous contract testing. As you can see, the same criteria apply here. The contracts in the group have cash flows that the entity expects will respond in similar ways to key drivers of risk in terms of amount and timing, and on inception had similar expected profitability. So the same two conditions that apply to the onerous contract test apply also to the allocation approach. So we have effectively the staff recommendation saying we're going to split the portfolio, but that inside the portfolio there is a unit of account which we're going to call the group, and that group, based on these two criteria, should always be the same. Now, this is true to some extent, because when you look at the second criteria under part C, you can see that there is something additional, and that is that the entity adjusts the allocation of the CSM for the group in the period to reflect the expected duration and size of the contracts remaining after the end of the period. Now, two things here. The first one, which is the key requirement to ensure there is an application of the objective, is the elimination of the CSM and the recognition through profit and loss of that balance for contracts that are no longer in place at the end of the period. And that's why you need to have a retrospective look at the movement in the in-force policy count, and if the policy count has declined for the particular groups more than expected, you need to ensure that an additional volume of CSM is recognized in profit and loss. If the decline of the contracts in that group is less than expected, then you need to ensure that there is less release of CSM in the period. So the period CSM recognition to profit and loss must be adjusted to reflect the proper actual level of in-force business at the end of the balance sheet, so that what remains in the liability to be earned in the future periods is properly connected with a group of contracts still in force. The other point, which is the one that I just wanted to flag to you, is the expected duration. In order to calculate the expected duration, you need to have a clear understanding of when the contract was incepted, in order for that factor to be measured appropriately over the period, and ensure that you are approaching the expiry date of the coverage in line with the passage of time that is associated with the coverage. And clearly, the amount of CSM that goes to P&L is different, all other things being equal, if the coverage period is different. So $100 P&L, $100 CSM will, over a 10-year period, will give a run rate of $10 a year, 100 divided by 10. The same $100 CSM for a 5-year coverage, expected coverage period, will have a $20 P&L release per year. So very different levels of release, and that's why, although you may have similar contracts in terms of the percentage of CSM over the premium, and the responsiveness to the risk in terms of amount and timing, if the duration is different, then this would create another need for subdivision inside the group and the portfolio. The reason I've expanded on that particular point is because there was some discussion in the first of the 2 days last week about a different recommendation to the one that you've seen on this slide. And in fact, there was a third criteria under Part C that was subsequently modified. In the debate, on the first of the 2 days, led the board to require the removal of that criterion. And that was indeed the criterion to have contracts grouped by the expected coverage period duration. And what the ISB decided to do was, instead of having that as a criteria, to introduce that effectively as a guidance, a piece of guidance on the mechanics of allocation. And that's why the reference to expected duration was highlighted in my slide that we just read together a moment ago. So the text that you've seen in the previous slide is the amended recommendation discussed on the 20th of January. The board members agreed that the new standard requires different levels of aggregation for different purposes. So now we have also clarity in that regard. And in particular, an example was given, which I thought was quite helpful to share with you. The level of aggregation for onerous contracts will be met by the same criteria in paragraph C, Roman 1. However, the number of contracts to determine the risk adjustment, for example, can be much greater than the number included in the group for onerous contract testing. And so we need to bear this in mind as we think about the implementation of these requirements, that the level of aggregation that computer systems and actuarial systems will have to be able to contend with is multiple levels. And so that's certainly an important feature to bear in mind. The discussion continued on that topic, and here I just would like to say the staff viewed that there should be no need to track individual contracts in the actual systems of an insurance company, but the group, once it has been calculated and aggregated, needs to be adjusted if the entity is aware that contracts in the group have been behaving differently. This is also where I'm still holding my breath on that particular comment that a group of board members made on the different evolution of the expected claims development of a subcomponent of a group of contracts which was a single group at the inception. At this stage, I have to say there are no signs that the board believes a reassessment will be required. However, I think it's better to be prudent, and this may come out as a sweep issue, even if the ballot will be approved next month to begin. Final point from the discussion is the fact that there was some discussion on the reference in Part A to the individual contracts and whether it was really necessary to do that. And the staff stated that the allocation would be made at the group level, but they believe the objective should be clearly stated in terms of the reference to the principle of the recognition equals full release of CSM. Nonetheless, the board did not accept the original draft, and these additional words were eventually added, and so that's the final text. If you overlay this bold text to the recommendation, you get the decision that was recorded in the ISB update this week, which is individual contracts, comma, or group of homogeneous contracts to be part of the objective. So that objective has now been modified to say individual contract or group of homogeneous contracts. And so effectively, this gives us also another indication as to what is this group going to look like. We are really talking about contracts which are very similar to each other. Once that discussion was completed and the amendment agreed, the vote was called in, and only 2 board members were against the recommendation as amended, and 12 were in favor, so a very large majority. Then the staff moved into the third part of their level of aggregation set of papers and talked about the effect of regulation and the possibility to have an exception on the level of aggregation rules and principles. And the recommendation here was that there should be no exception to the level of aggregation for determining onerous contracts or the allocation of the CSM when regulation affects the pricing of contracts. That means that groups of contracts that have dissimilar expected profitability as a result of regulation, all other things being equal, cannot be grouped together for onerous contract testing and allocation. So we will have to split them. Now, the discussion here was, again, another lively one, and gender equality regulations were considered. I presume most of you are familiar with the fact that under these regulations, insurers need to charge the same premium to male and female policyholders, even if the risks may be statistically different. Motor insurance is an example that comes to mind, but there are many other instances where gender equality regulations would actually require the insurer to price a unisex premium, effectively, even if statistical evidence would indicate that the risks carried by male policyholder is higher or lower than the one carried by a female policyholder. If you look at the economics of such a business, you may argue that there will be an element of the premiums paid in the instance of female being less risky, premiums paid by the female policyholders, which may be subsidizing claims incurred by the male policyholders if the female policyholders are less costly from an expected claims perspective. Overall, the profitability could be argued to be combined by the two halves of the risk and still be grouped together. Others would say actually no. If one group of policyholders is clearly more costly than the other one, then the profitability, if there is a requirement to price the two types of risks in the same way, is different. And therefore it's more informative for an investor to understand how big is the male portfolio versus the female portfolio in terms of their relative profitability going forward. So if you take that line of thought, then you would split the group in two parts. And those that believe that this is a more faithful representation, they would say that it's actually useful for investors to understand where the pools of profit happen to be across the total business in force of an insurance company. The debate I highlighted the fact that a very large number of the ISB members were thinking along those lines, but not all of them. And a minority of board members noted that this direction was dangerous, and it was not recognizing the fact that despite the imposition of a pricing equalization approach for the risk, the similarity of the risk was managed economically as a single pool, and they would have preferred not to see that exception excluded from the final text of the standard. And they also said if we are going to write a regulation in the standard, we also need to say what regulation is that, and that is going to be a dangerous precedent not only for the insurance contracts IFRS but also for other contracts, because regulations on pricing is a reality that is not just isolated to the insurance sector. There are other sectors in the economy that may be affected by similar impositions, and so they noted their discomfort to that. However, when the votes came and the two camps were counted, it was the camp that agreed with the staff that won the day, and 10 board members were in favor of not making an exception to the rules on aggregation as a result of the effect of regulation, and only 4 were of the view that such an exception would have instead be necessary. So we are moving towards an area where even when we have imposition from the external world, being laws in the regulations to the insurer on the pricing of risk, if that creates 32 subsets of policyholders, we will have to group them separately in terms of testing onerous contract and allocating CSM over time. I'd like now to move to the second big topic discussed last week, which is the accounting for indirect participating contracts, or if I quote the title of the staff paper, the specification of the effect of discretion in the general measurement model. Now, again, I'll start with the overview of the issue and the reason why the recommendation that I'll explain in a second was developed as it was. Now, you all remember that over the last 7 months, the board has made a major leap forward in addressing the fundamental negative criticism that was given to them out of the proposal in the 2013 exposure draft on how to account for participating contracts. So that criticism said abandon the mirroring approach and develop a new method which is now being developed and is called the variable fee approach, the VFA. That approach applies under some strict criteria, which we presented in previous webcasts. And if you pass those criteria, you have in your hands a direct participating contracts. If you don't, and you still have cash flows which are dependent on asset values, you end up having what is been defined as an indirect participating contracts, and a lot of debate has been done on this as to whether or not the VFA should be restricted to direct participating only or not. And the decision that the board seems to be moving towards up until last week was that they should not be moved into the VFA scope, and instead they should be kept in the general measurement model approach. However, these past few months, I've seen a degree of attempt to analyze how the general measurement model would apply to indirect participating. And you probably remember from our webcast summarizing the outcome of the November ISB meeting that there was already an attempt in that meeting to reach an agreement on how to account for the discretion when the VFA was not applicable. And at that time, the board considered 4 different ways to distinguish changes caused by market variables and changes in discretionary cash flows. At that meeting, the ISB staff recommended to use the market as the benchmark to determine which effect of discretion should be accounted for against the CSM and which should be taken instead to the statement of comprehensive income. But the board was not satisfied with the proposal at the time and deferred the topic to a future meeting, which is why the staff brought it back last week. In these new set of papers, the one that was tabled last week, the staff explained that the approach that the ISB wanted to take into account the expected level of discretion by the insurer would require the entity that issues those contracts to specify at inception of the contract how that level of projected future discretionary bonuses looks like, and then to use that specification to distinguish over time how the changes in market variables will be affected by the modification of that level of discretionary bonuses versus the pure effect of market variables. If that was the direction, then the staff noted there would be 2 finely balanced viable alternatives, which the paper asked the board to consider. The first one is that the entity will be required to specify the effect of discretion at inception, or going back to the proposal that was tabled in November, the entity would determine the effect of discretion by reference to the market in each reporting period. So the staff asked the board, what would you like to do? Now, this was an interesting debate because Alternative A seems to provide some very useful information, according to the discussion we heard at the meeting, to investors in that it offers them the opportunity to appreciate what is the targeted rate of return payable to the policyholders. And so that's something that an investor would find useful, not only an investor, also policyholder probably. Now, the debate confirmed the view of many board members that in many cases they believe, and the staff seems to confirm that they also have empirical evidence of that, that it's possible to identify the effect of this discretionary policy on the fulfillment cash flows arising from the contractor and separate it from other changes in market variables. In conclusion, the board was then satisfied that they could actually take an approach which would combine the two alternatives into one. So effectively they synthesized the alternatives into a single unit that included both part A and B. And effectively said what we want in the requirement of the standard for these contracts is that first of all, we will ask the insurer to attempt to define what the expectation of the discretionary amounts due to policyholders would be, and if that is possible, to do so, and to define that expectation as the level of cash flows that, based on the underlying variables defined in the level of future bonuses, would then create a change in cash flows to be accounted for against the CSM, because that was the objective that they all wanted to achieve, was to effectively separate the changes in cash flows between the portion that goes to CSM and the portion that goes not to CSM. And once you have done this discretionary identification of the future cash flows and future bonuses, anything else that would be arising from movement in market variables would be accounted for in P&L or OCI using the same principle that the IASB already approved months ago on the presentation of discount rates, when they said discount rates and any changes in cash flows associated with market variables will be presented in the same way. And so if the discount rate is presented between P&L and OCI, because you have elected the OCI solution, so would be the cash flows associated with market variables. And in this particular instance, the indirect participating contracts, you will look at the cash flows that are effectively driven by market variables. The component of the market variables that is part of the projected discretionary bonuses will be booked against the CSM and become part of the unlocking together with the known market variables changes. Everything else will still be market variable only, pure market variable, and will follow the classification in the statement of comprehensive income that you have elected for the discount rate, which is either the split between P&L and OCI or recognizing everything into P&L. So that is the direction that the IASB took eventually on this very difficult issue. Personally, I'm not entirely satisfied that this is the best solution, but it is certainly moving in the right direction. And now my team and I have already been busy studying the practical application of this requirement to see how the P&L of contracts that have got these features will effectively change as a result of this clarification. At the end of the discussion, given that the board changed substantially the staff starting point, you could see that the debate was already creating consensus, and the vote was unanimous in favor of this decision to merge the two alternatives into effectively a synthesis of the two to create a combined accounting approach. If, in fact, if the possibility to define this discretionary projected level of returns is not available, Part B then comes in, and the expected market return of the contract becomes the default reference for the exercise of discretion. So that's how Part B would be salvaged in the final requirement, but is a secondary scenario application only rather than the primary, as the staff suggested in the first place back in November. And that's the last of the points to brief you on the outcome of the meeting last week. We now have seen also two papers which were not debated, but paper 2C and 2D, give us the way forward. And there are papers stating that in the analysis of the staff, the proposals for accounting for insurance contracts are sufficiently developed to begin the balloting process. In addition, they also state that the board has complied with all the steps required in its due process handbook. And so that means that comes next month, in the February meeting, the staffs will be asking the board to formally review the due process steps and agree that, or disagree, that's possible as well, that those steps have been or have not been completed, and if they are being completed, seek permission to begin the balloting process, which is effectively the drafting process that would then lead to three things. The first one is a much more detailed analysis of all the tentative decisions taken to date against the text of the exposure draft and all the records of those decisions, and until the full standard is complete. Second, any so-called sweep issues that may arise as a result of the drafting will be brought back to the board in public session for discussion and decision. And thirdly, at some point, similar to what the ISB has done for the leasing standard, there will also be a confirmation as to which effective date, mandatory effective date, the board wishes to publish when the standard which is likely to be released as IFRS 17 insurance contracts will contain. So we have still some way to go, but the intensity of the debate and also the focus of our webcast will have to change accordingly. So we will clearly continue to follow. The February meeting will be covered by our webcast in late February. Then we also have the redeliberation on the IFRS 9 decoupling exposure draft. The comment period ends on the 8th of February. And we anticipate that in the March meeting, that topic will be brought back to the board to analyze the comments and start deliberating what to do in IFRS 4, because IFRS 4 will have to continue. Given that the ISB is going to give a long implementation timeline to IFRS 17, also known as IFRS 4 Phase 2, we will have a period of at least 3 years, in our opinion, in Deloitte opinion, where both standards will exist, and IFRS 4 will contain the provisions to implement whatever is going to be the final solution on the decoupling issue to avoid or substantially mitigate the accounting mismatch that will arise from the adoption of IFRS 9 before the effective date of IFRS 4 Phase 2. So all these things are going to be covered, and we'll continue to cover them in the webcast in the coming months. In addition, we will start analyzing in a bit more detail the more complex areas of the new standard and help you in your assessment that these requirements will have on your business to aid your efforts on implementation. That is my last message for today. I would like to take you now to my final slide to remind you of the various options available to stay up to date via Deloitte on this particular project and to open the floor for any questions as we stop the recording.